Hello! This is another episode of Business English with Lukasz Angowski. In this episode, I will talk about what assets and liabilities are. I will also explain what owner's equity is, and explain how you can calculate your personal net worth. If you are interested, please keep listening. Every business's financial condition is reflected in its financial sheet, which typically consists of three main components: assets, liabilities, and owner's equity. An asset is any possession that has commercial or exchange value. It means anything you can sell and make money on is your asset. These are the positions in your balance sheet that will always have a positive value. For example, if you own a car that is treated as a company's car, or you possess a building that you use as an office, these are your assets. You can always sell the car and the building and turn them into cash. We divide assets into three main groups: current assets, fixed assets, intangible assets. Current assets are short-term assets. This can include cash, money that customers owe to a company, also known as accounts receivable, stocks, bonds, or anything with short-term expiry a company uses to make a product. Current assets are usually converted into cash or consumed within a year. This is why they are often called liquid. In this case, if we say liquid, we mean that in case of need, you can easily dispose of the given asset, exchanging it for money. Fixed assets are long-term assets that the company plans to keep longer than for 1 year. These typically include land, buildings, machinery, furniture, etc. They help to produce income, but they are not directly affected by the profits the company makes. Intangible assets are not something you can see or touch. These are not physical or material, but still can make money. They include trademarks, patents, copyrights, and licenses. If some other company wants to use your patent, they need to pay you for it. If someone violates your copyrights, they also need to pay, usually in the form of compensation pay. Apart from assets, companies also need to track their liabilities. These are the company's debts and obligations. Simply put, we can say liabilities are the opposite of assets. They are divided into current liabilities and long-term liabilities. Current liabilities are debts that must be repaid within a year. These might include debts to creditors, bills, employee payrolls, or bank overdrafts. Long-term liabilities are debts that take longer than 12 months to pay. Once a company prepares its balance sheet with all the assets and liabilities and the difference between the two is established, this shows the net worth of a company, also known as owner's equity or capital. Let me use a more practical example to explain this better. In your private life, there are things you own, like a laptop, a flat, a car, and some cash in your saving account. These are your assets. If you add the total value of these assets, you will see the total assets value as a number. On the other hand, maybe you pay the mortgage for your flat each month, and your laptop was not bought for cash, but rather you took the loan from the bank to buy it. If you add the money you still owe to the bank for both the laptop and your flat, these are your total liabilities. Once you see the difference between the two, you are able to understand your actual net worth. Suppose all your assets are worth $160,000, but your liabilities are $100,000. This means your actual net value is $60,000. Not bad. Try to always keep your net value above zero. This means you own more than you owe. People who do not follow that rule often go bankrupt. That's it for today's episode. I hope you enjoyed it. If so, please leave a comment in the comments section and do not hesitate to subscribe to my channel. Thank you.